What's up everyone, I'm Brad, and today I'm going to show you why the stock market has been going straight up for years, even in the middle of a global pandemic, and why I don't think that's going to change anytime soon. Let's jump in.
Okay, we are in the computer, so now is the time to go below the video and hit that like button and the subscribe button. I'd be much obliged. Thank you. Okay, so we got TradingView pulled up. I got the S&P 500 chart, and you can see we've just been going in an upward trend for years and years now. So why is that? Even in the middle of a global pandemic, COVID-19, we had this massive crash and we just came right back. Well, there's one easy answer for that, and that is the Federal Reserve. If you guys aren't familiar with the Federal Reserve, it's basically the United States Central Bank. You just do a quick Google search, Federal Reserve, and you get some pretty good information on Wikipedia if you want. But yeah, it's the United States Central Bank. They control the money supply for the country, and right now they are trying to keep rates that they lend money out to the banks as low as possible, and they are buying bonds with the money that they print at a incredible rate that I'm going to show you on this chart right here. So those two things in turn have pushed the stock market higher, and I'm going to explain that. So basically, it started back in 2009 with the housing bubble stock market crash. When that happened, the Fed came in and said, you know what, we're going to start buying up these mortgage-backed securities, upwards of over $1 trillion. So when the stock market was crashing, they came in to help out. And sure enough, look at the stock market. This is this orange line right here. That's the stock market. This blue line is the Federal Reserve balance sheet. So it shows basically how how many bonds, how many mortgage-backed securities they've bought, or how much they have on their balance sheet. And you can see the overlap with the market. So in 2009, when we crashed, they came in, started buying up all those securities, and the market just started coming back. All right, so that was called QE1, quantitative easing, and that was the first time they did it, so we call it QE1. Well, they did it again, called it QE2, right, at the 2010-2011 fall winter, and into the middle of 2011, they did it again. Then we had QE3 towards the end of 2012 and all the way towards the end of 2014. And look at the stock market just go straight up when they were pumping in, well, 40 and 45, so $85 billion a month. They were just buying up mortgage-backed securities and bonds to suppress interest rates and to suppress the bond market. So the bond side of that is basically they're going in and buying up all these bonds, and which lowers interest rates on bonds. So when an investor comes in with money, like me or you, and we say, what do we want to invest our money in right now? Well, we have stocks, we have bonds, we have commodities, things like that. And the stock market historically has given us, maybe a 10%-ish rate of return, but there's some risk there with stocks. Bonds, depending on what kind of bond you buy, maybe you get 3% or 4%, but the risk is basically zero. Well, when the Fed comes in and suppresses those interest rates on those bonds to down to 1% or 2%, that factors into an investor's decision on whether they want to go with stocks or bonds, right? So bonds aren't as appealing to investors anymore. I don't want to invest my money for 1% a year, so that leaves me with stocks, assuming that commodities is not an option, is not appealing to the investor. That leaves you with stocks, leaves you with the stock market. And that's kind of been the sentiment for a long time now, is that the stock market is just the only option for investing. So the Fed has done that by implementing these programs. So we see this massive gain in the stock market here for QE3. And then there was no QE for a while. And look what happened. In 2015, we just went sideways. Funny how that happens, huh? And then 2016 happens, and we kind of go sideways for a little while, and then we start going up. Because what happened in 2016? Donald Trump was elected, a Republican, who ran on, his whole platform was he's going to make the economy better, right? He's going to bring jobs back to America. He's going to bring production back to America. He's going to make America great again, right? So that clearly worked for the market. The market just started going up organically by itself without the help of the Fed. That's important to know here as we go into this next segment. The Fed sees this and they say, you know what? The economy is doing really good right now. I think we can start to pull back. We can start to reduce our balance sheet. They're going to start getting rid of some of these mortgage-backed securities, these bonds, very gradually. So you see their balance sheet start to wean off a little bit, right? Look what happens in the stock market. It's no longer going straight up anymore. Now you're starting to see a little bit more volatility. It's kind of going sideways, but sideways in a very volatile way, right? So we're kind of chopping around. And that's kind of where we left off. We saw some gains coming up into 2020, but it's still pretty choppy, right? It's definitely not like what this was, where it just seemed like we were just going straight up forever, other than this 1 year. And there was a reason for that 1 year that we talked about too. So, in comes 2020, global pandemic, and the Federal Reserve is trying to get rid of these bonds and mortgage-backed securities, and then the economy crashes, right? Right here, just crashes because the coronavirus hit and we shut down the economy and 40 million people lost their jobs, and there was, it was just absolute fear, blood in the streets. So right at the bottom of this, they said, whoa, okay, we'll do something again. Quantitative easing, quantitative easing for $1.5 trillion coming into the economy. Look at the balance sheet, just go straight up. And wouldn't you know it, that coincides with this rally. And they've been doing it ever since. That is the reason why the stock market has gone straight up. If you've ever heard of the phrases "don't fight the Fed" or "can't fight the Fed," that's what this comes from. You can't fight it. The machine is just too big. They're pumping too much money into the market. So, what I'm doing, I'm sticking with it until they let up. That's all I have, guys. Thanks for watching. Let me know in the comments below if you agree or disagree with the Fed being the main reason why the stock market has just been going straight up all this time. Thanks.